Well, welcome to our webinar today on retirement planning. This webinar is a little bit different than the monthly ones we normally do for our clients and prospects, where we go over one topic like estate planning or inflation or those kind of things, where we're also hosting this webinar today for people that were going to come to a dinner seminar we were going to have here in Lincoln on last night and Thursday night that we had to cancel because of the mask mandate. And I decided that I wasn't going to wear a mask or ask any of my guests to wear masks. And so we're taking care of the information with doing that this way with the webinar. I'm Bob Benny, certified financial planner and a fiduciary.
And I'm Jessie Thompson.
We're both financial advisors here at Bob Benny Wealth Management. So go ahead and tell them how to, if they have any questions.
So as we're going through, if you have any questions, down at the bottom of your screen, there's a Q&A box that you can click, and you can type in your name if you want, or you can remain anonymous in your question. And that's just to let us know who asked the question. We're not going to say your name, but we're going to go over all the questions at the end. So if you think of any while we're going through, feel free to type them in. Also,
although this is a Zoom meeting, it's a webinar and we can't see you or hear you. So the only way you can communicate is back to us live while we're doing this is with the Q&A. Or certainly you can give us a call or an email afterwards.
So let's go ahead and go over what we're going to be talking about today and what was on your invitation. So the first subject we're going to talk about is investment returns, and we're going to answer the question of can your retirement investments weather the markets and still provide income that you need, and what safety measures can you take to protect your portfolio?
We're going to talk about inflation strategies, because a lot of people are concerned, and rightly concerned, about inflation, and especially high hyperinflation that is already starting to happen, and how you can protect yourself.
And we'll talk about your mortgage and whether or not it's a good idea to pay it off early.
We'll also go through briefly, or it won't end up being that briefly, but we'll talk about optimizing Social Security for you, when you should start drawing benefits, and how important it is to correctly time when you take Social Security.
We'll also go over longevity considerations and how you can plan so that you don't run out of money before you run out of breath.
And finally, we'll finish with talking a little bit about estate planning, and how when you pass away, you can efficiently transfer your wealth to your loved ones and save taxes and probate or legal expenses.
Okay, so let's jump right into investment returns.
So the question on this topic was, can your retirement investments weather the markets and still provide you the income that you need, and what safety measures can you take to protect your portfolio? These are graphs of the stock market, the S&P 500, the Dow Jones Industrial Average. They're both indexes that are used to measure the stock market. You can see they're almost identical to each other. A general upwards trend over the last 20 years. However, in 2008 and 9, we had a really big drop, a 50+% drop, 51% over a year and a half in 2008 and 9. Took the market a few years to recover. In 2020, last year in the spring, because of the COVID scare, we had a 31% drop in the market in about a month and a half, and it took it only about a month and a half or so to recover. But these are the reasons that it's important to have strategies to protect your portfolio in retirement, because that can be really scary, a 50 or 30% drop in your investment portfolio when that's what you're supplementing your retirement income from Social Security with. So the traditional investment strategies that you may have heard of are buy and hold, and you may or may not have heard of a thing called modern portfolio theory. So first off, on buy and hold is the idea that if you just buy quality stocks or stock funds and hold on to them over the long time, that you'll be fine. Well, I think that used to be correct, that you could buy a quality fund or a quality stock and be fine. But nowadays, with the economy changing, political considerations, technology advancing so quickly, the old buy and hold, the buy and hold strategy, I about said old buy and hold. The old buy and hold strategy is old and it's no longer valid. To kind of give you an idea about that, remember back, over 100 years ago when they invented the automobiles, if you had a buy and hold strategy that you invested in buggy whip manufacturing and you just stuck with that investment, you'd lose all your money, because as people started driving cars instead of using horses and buggies, nobody needed buggy whips anymore. So that's kind of the situation we're in with technology and the changes that are going on, as well as other things like I was talking about, global economy, political considerations, et cetera, that people need to be more light on their feet and be able to make changes rather than just have the buy and hold strategy. The other strategy that was up on the screen, or is up on the screen, is called modern portfolio theory, and you may or may not have ever heard of that. But modern portfolio theory isn't so modern anymore. It was named the modern portfolio theory in the 80s and 1980s. And it basically says that as you get older, more and more of your allocation of your investments should be in bonds. Generally, the idea was that about whatever your age was, that's the percentage of your portfolio that should be in bonds. Well, that's no longer true. That would mean that somebody that was 60 should, or let's say 70, should have 70% of their money in bonds and 30% in equities. Well, it's not true anymore, for at least particularly in this environment, because interest rates are so low, is one thing. And as interest rates go up, which they will because of inflation, which I'm going to talk about a little bit, bond values will go down. And the other reason is we're living longer. People are living a lot longer, and we're going to talk about longevity in a little bit. And so the modern portfolio theory of allocating based on your age to bonds and stocks is no longer valid. We use a different strategies in our practice here. Modern portfolio theory and buy and hold strategies are gone. I mostly invest people's money one of two ways, either in managed accounts or this other way I'll talk about in a minute. The managed accounts I have discretion over, and I manage them using ETFs. ETFs stands for exchange traded fund. They're like index funds, and I manage them based on the particular amount of risk that the clients want. But I'm able to quickly make changes if necessary because of what's going on in markets, or in particular investments, or the economy. Another advantage of using these ETFs rather than mutual funds is the next strategy that we sometimes use, and that's called a stop loss order. Because ETFs are technically stocks, they can be traded any second of any business day. Unlike a mutual fund, where if you sell a mutual fund, you get the closing price for the day. So if you needed to get out of an investment quickly, or out of a market quickly, you can't get out of it quickly with a mutual fund. One of the key characteristics of an ETF also that we can't do with a mutual fund but can do with an ETF is set a stop loss order. And that means that I can set a price at which, if that security, that ETF, falls down to that price, goes down to that certain price, like say you bought it at 100 and we set a stop loss order at 90. If the price goes to 90, it automatically, it's a computer generated sell order, automatically sells you out. It's kind of like a parachute protecting your investment. And that's certainly something that we can explain to you further if you are interested in giving us a call or coming in and seeing me. The second general way that we invest money for our clients, it kind of goes about half and half, is with a concept I call portfolio insurance. It's analogous to homeowners insurance on your home. Most all of us have, should I take this call? most all of us have homeowners insurance on our house, is to insure against a catastrophe like a fire or a tornado. We pay almost 1% of the value of the home for our homeowners insurance. And most of us will have that homeowners insurance and pay that 1% for the rest of our lives till the day we die. And most of us will never have had a catastrophic loss like a tornado or a fire. Well, portfolio insurance is there are investments that we can invest your money in, that you're invested in the stock market, and have the growth potential of the stock market. But an insurance company provides guarantees protecting your income for life, or protecting your investment for your beneficiaries. If the investment was to go down and you were to die, your beneficiaries would get the higher amount. But that insurance, just like homeowners insurance, costs a little under 1% per year to insure against this catastrophic loss that is probably not going to happen. There's probably going to be times, if you live to your life expectancy, multiple times, that there's going to be a big drop in the stock market. This portfolio insurance with the income guarantee and the death guarantee will run you in the ballpark of 1 or 2%. If it's both living and death benefit, it'll be more like the 2% level. So that's going to draw on your returns, but it may give you may be willing to pay that for the peace of mind that you get to protect your income. So anyway, if that's something that you'd like more information on, you can contact us and set a phone appointment or an in-office appointment to discuss that.
So let's move on to the subject of inflation and how you can protect your investments from inflation. So the definition of inflation is the rising cost of goods and services. So we've all been experiencing inflation, especially in the last year, more than any time in my lifetime. The inflation rate at the end of 2020 was 1.4%. And in June and July of this year, it was 5.4%.
Yeah. So
it's jumped a lot this year, and it looks like it's around to stay. So can you think of some examples of inflation?
Well, I mean, everybody that puts gas in their car, gas a year ago was $2 a gallon. Now it's $3 a gallon, round figures. That's a 50% increase in gasoline. And it doesn't just affect what I put in my car. All the goods that we buy, groceries, anything you buy has to be transported. So that's an increased cost in the transportation of goods all across the country. We've also seen the increase in inflation at the grocery store, substantial increases in the prices of groceries, especially meat. We've seen the increase in inflation in real estate, especially homes, but also farmland, and so on and so forth. And inflation is here to stay, and it's going to get worse. And that's very important for investors and all of us to keep in mind, because I believe it's probably the greatest risk for Americans right now financially is the risk of inflation reducing the buying power of their dollars.
So let's talk about the worst investments that you can own during a period of high inflation. So things that you do not want to own right now and in the near future.
Or as we go through this inflation.
As we go through this. Right. So cash and cash equivalents, that's basically money in the bank. So lots of money in your checkings or savings account. Also having a high allocation of cash in your investment account. Usually that's an allocation in a money market account. It's kind of the same thing as having money in the bank. It's a very, very low interest rate that you're getting. Additionally, CDs and bonds and bond mutual funds.
The problem with having these cash equivalents, or even bonds, cash or cash equivalents, you're losing buying power with your money. So if you have $100,000 in the bank and you leave it sit in the bank not making anything, or making 0.5% or 0.1% for a year, and we have inflation only at 5%, a year later that $100,000 is only going to be able to buy $95,000 worth of stuff. If it's 10% inflation, you're only going to be able to buy $90,000 worth of stuff. The reason you don't want to own bonds too is not only do they pay relatively low interest rates, maybe higher than the cash, but maybe you're making 3 or 4% if you're lucky your bonds. But what's going to happen is as interest rates go up, or I mean, as interest rates are going to go up, they're going to go up because that's how the government is going to head off inflation. It's the only tool that they have to head off this high inflation. And so what they're going to do is they're going to raise interest rates. And think of interest rates and bond prices as like on a teeter-totter. If interest rates are over here and bond prices are over here on my hand off the screen, interest rates are low and bond prices are high. When interest rates go up, bond prices, bond market values are going to go down in value. In fact, they'll go down so much if there's a significant increase in interest rates. The bond prices will go down so much that they'll go down even more than the interest that you're getting paid on a bond. So if you're getting paid 3% on a bond and the bond market price goes down 10%, you lost money on bonds. So this is not a good investment to have as this inflation hits.
So let's talk about the good investments to have during inflation. The best kind of investments that you can own as a hedge against inflation are one, investing in companies. So owning portions of companies, that would mean you own stock in companies, you own mutual funds that are invested in stocks, or you own ETFs like we talked about earlier, the exchange traded funds that are invested in stocks.
Yeah.
And so when you think about the definition of inflation being a rising cost in goods and services, it's companies who are producing those goods and services that are rising in cost. And so that's why investing in companies is an excellent hedge against inflation. Additionally, investing in real estate and investing in gold.
Those are good hedges against inflation. So the do we have another next slide or? Oh. So the next thing we want to talk about is your mortgage. And some people have been talking to me, or I guess I want to finish with a couple of other strategies that somebody might think about for inflation quickly. Two things that are strategies to help yourself when you know that there's going to be, help yourself financially when you know there's going to be high inflation. One is if you have any major appliance purchases that you might be wanting to buy in the next year or two, might be a good idea to buy them now if you can find them, because appliance prices are going to go up and up and up and up. So you might as well buy them now. Another thing, while mortgage rates are low, this would be a great time to refinance your house if you haven't already refinanced your house. So that brings us to our next topic, which was your mortgage and whether you should pay off your mortgage early. And, you know, I've had a number of people come and talk to me, clients and prospects, particularly in the last 3 or 4 or 5 months, asking me if they should, you know, they have $100,000 in the bank, should I pay off my house early? And my answer is, unless you're paying 10% interest rate on your mortgage, no, you shouldn't pay off your house early. You should have hopefully already refinanced. And you ought to have a mortgage in the ballpark of anywhere as down as low as 2% to as high as 3.5%. If you haven't already done that, you should refinance your house. But the thing that's cool about these low interest rates is it's an opportunity for all of us, because they're locked in for 15 or 30 years. They're stuck. And when interest rates go up, and interest rates on money markets and CDs are in the 5-8% range, or interest rates on mortgages are even higher than that, you're going to be thrilled that you're only paying 3% to rent this money on your house. And the inflation rate is certainly going to be higher than 3%, and you ought to be able to be making more money than 3% on your investments. This is a historical graph of U.S. mortgage interest rates going back to the early 70s. And in the 70s and early 80s, we had this really high inflation. And look at how interest rates on mortgages went. They went up to as high as over 18% in the early 1980s. Can you imagine having to pay 18% on your mortgage? If you had a $100,000 mortgage, you'd have to pay $18,000 worth of interest every year. And look at how mortgage interest rates have gone down now, and down to rock bottom lows. They literally have nowhere to go but up. but they will go up because of this inflation. It's the government's only thing that, like I mentioned before, that they can do to combat inflation. So keeping or refinancing to a low 3.5%, whatever you can get on your mortgage is a good time, and not to be in any kind of hurry to pay off your house.
So let's move on to Social Security optimization. Now, this section is going to be very, there's no one size fits all for when you should take Social Security and kind of what's at stake. It's very individualized and it depends on several factors, including how long you expect to live, whether or not you're married and what your monthly benefit is and your spouse's monthly benefit, and then also taking into consideration taxes. So
if I could interrupt, one other thing that's not on there that you got to consider on when to take Social Security is, what your situation is. Are you able financially to, for instance, retire now and wait to take Social Security in a few years when you get a higher, when you get a higher amount, which we're going to talk about. And so it's going to depend on what your financial situation is, how much money you have in savings or retirement accounts too. So that's another. So for everybody, it's different. Every situation is different.
And it's a complicated calculation if you take into account the different scenarios. And so it's important to use, and there's different softwares out there. What we use is a software called Social Security Timing that you can input your information into, your life expectancy, your benefits, your spouse's benefits, things like that, and run through different scenarios that will give you a better idea so that you can make the right choice for when to start taking and how much money is at stake. So we're going to go through just kind of a quick example of how that works. This is a report that we can easily run for you, but we're going to hypothetically run it for John and Jane Smith. So this is John Smith. He is a higher wage earner in the marriage. His full retirement age is 67. Full retirement age is the age at which he'll receive 100% of his Social Security. Anyone can take Social Security starting at age 62, or they can wait until as late as age 70. But you're docked for benefits if you take early, and you have benefits added on if you wait until after your full retirement age. But his full retirement age is 67. Right now, he's 61, and his life expectancy is 85, just based on his health and family history. That's how long he expects himself to live. So he's married to Jane, and she is a lower wage earner, so she has a little bit lower Social Security than John. Her full retirement age is also age 67, but she's a little bit younger than John, so she's 56 right now, and she expects to live to age 90.
So this next page that Jesse's going to talk about is one of the pages on the several page, 12 page or more report that we give people after we run the Social Security analysis for them, after interviewing them and finding out their details. And this is showing some different possible strategies that the report gives us.
Yep, for John and Jane. So plugging in their information that we just talked about, it suggests several strategies from basically best to worst based on the life expectancy that they put in. So if they live to their full life expectancy, they're going to get the most money if John waits to file till age 70 and John files at age 65, and that's that blue bar that shows $807,133. And what these dollar amounts are is they're the present value of future dollars. So takes into account inflation,
right,
and brings
all those dollars back to present value dollars, so that we can have an apples to apples comparison of the different timing of all the different strategies. And we're just showing with this bar, or with this bar chart, it's just showing the maximum, which is in the blue bar, the 807. That's how they maximize the present value dollars. And then in the red bar, it's if they take the earliest they can, which is at age 67. You can see it's about over $110,000 difference between the suggested strategy and taking it earliest. And then we also have an alternate strategy that we put in there, that you put in there for them, of both of them taking at age 67 full retirement age, and that's in between.
And that's a really good way to, that's a really good concrete way to see how much money is at stake, depending on when you decide to start taking benefits. So going along with that and kind of how you can help with your retirement income planning off of this software and using this report, this is an income gap chart. So in the bars at the bottom that are black and green, that shows John and Jane's Social Security when they start taking. So this is based on that ideal scenario that we showed before, where John takes at 70 and Jane takes at 65. So they're starting to take in 2030. Now, they've told us that they are used to living off of $6,000 a month. So that green bar with the dots at the top basically shows $6,000. So what this chart shows is how far their Social Security gets them to their income need and how much gap they are going to need to make up with their retirement investments or from somewhere else.
Yeah, and that's where we come in as far as helping people plan for retirement and plan how we're going to fill that, how they're going to fill that gap. You know, for instance, if their Social Security income between the two of them is $4,000 and their income need is $6,000, we help them figure out how to invest their money and milk the cow, so to speak, for $2,000 a month. And I use this cow analogy a lot. I don't really know exactly why, other than I have a little bit of an agriculture background, but I think of people's retirement money and all their money put together when they retire as like one big retirement milk cow. And that what we want to do is, what I want to help people do is start milking the cow carefully so that the cow continues to get bigger, so that they get more and more milk out of it over time, to help them as the cost of living goes up. And because the last thing we want to do is hurt the cow or kill the cow and then not have income or run out of money before we run out of bread.
So that brings us to our next subject of discussion, which is longevity concerns.
So this graph is a graph of the historical and projected life expectancy of Americans. It started out, the graph starts in 1960, runs it out, projected to 2060. You know, when they first started Social Security and taking money out of people's paychecks for Social Security in the late 1930s, life expectancy for Americans was under 65. So they were taking money out of people's paycheck to pay for a government pension that most likely most people wouldn't live long enough to get the government pension. Of course, now a lot of people are on Social Security. In the 1960s, though, if you look, the center of those lines is the average between men and women, the gray line. In the 1960s, life expectancy for Americans was just under 70. So people would maybe have about 5 years in retirement if they retired at 65. However, now, now in the year 2021, life expectancy for most Americans is over 80, and it's projected to go much longer, much older than that because of, medical healthcare benefits, those kind of things, healthcare technology, that kind of thing. So people are living longer. So now when people are retiring in their 60s or 65 or 67 or whatever, they don't just have to look forward to a few years or 5 or 10 years in retirement. They may have to be looking forward to, 20, 30 years or longer in retirement. And that's why retirement income planning is so important, taking into consideration different kinds of factors like, how the gap's going to be filled with their investments, the gap between what they get for their automatic Social Security payments and pension and whatnot. And so that's what we do. And we do that with these managed accounts and protecting money with stop loss orders or protecting money with portfolio insurance and that sort of thing to help people's retirement be safer and more stable than it might otherwise be. So while we're talking about this, I just want to generally share that most investments, all investments fall into one or two categories: ownership versus loanership investments. Ownership investments are assets that you own, like companies, real estate, gold that we were talking about before. Most of those investments, particularly companies in real estate, produce something. You know, real estate produces a rent, and it also can appreciate in value. Companies produce or you know, a good or a service and sell it at a profit, and they pay out dividends, or they go up in value because they're making money. Ownership investments versus loanership investments is where you're renting your money out. You're renting it out to a bank or a company or the government. Historically, over the long haul, ownership investments, long haul meaning 5 years or greater, ownership investments always outperform loanership investments historically over the long haul. Right now, particularly, is a very favorable time to have ownership investments, not loanership investments. I like to tell this story about 6 years ago. My office is up on the north end of town. And interestingly, north of my office was a community called Autumn Wood, a neighborhood. It was a retirement community where, in order to own a home in that community, you had to be 55 years or older. So I went up there and just met everybody. I went door to door, passed out my card, told them what I did, financial advisor and whatnot. And something that I found very interesting was the people that had lived there for a while or had been retired for a while, that were in their mid-80s. Now this is, let's say 1995. So the people that were in their mid-80s and had retired 15 or 20 years prior, they ended up being in two kind of categories of people, of investors. Both of them had issues they were concerned about, but they were very different issues they were concerned about, because both of these categories of people had did different things when they retired 15 or 20 years earlier, when they retired and took their 401k and rolled it over into an IRA and started milking the cow, so to speak, or when they were farmers and they retired and sold the farm and took the money and started using it for income, milking the cow, so to speak. The one camp over here on this hand, they, at the time that those folks retired in the late 70s, early 80s, they had taken their money and taken it to the bank and put it in CDs, because they were getting really high interest rates, because, as you remember, the interest rate chart of the CDs, and they were, you know, pretty happy. They were getting, you know, 12, 13% on their CDs. And the CD just kept rolling over and rolling over. And unfortunately, the interest rates kept going down, 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 down. And now in their 80s, after 15, 20 years invested like that, and those loanership investments not keeping up with inflation, these people over that had done that strategy, with financial strategy for their retirement income, they were worried about what the next Social Security cost of living increase was going to be, because they were having a hard time making ends meet. The other category of investors that were in their 80s, that had been retired 15, 20 years or so, when they had retired, they had taken their proceeds from their 401k or the sale of their farm or whatever most of their retirement nest egg was, and invested it in large part or all in the stock market, in companies or in stock mutual funds. Those people, their investment portfolio had not only kept up with inflation, but exceeded inflation greatly, such that their concern now in their mid-80s was, as they neared the twilight of their life, was, how do I pass this money on to my loved ones without a whole bunch of taxes, without the government getting it? And so, wouldn't you rather be in the camp over here that has to worry about, not have to worry about the next cost of living increase on Social Security because you can't make ends meet. But on the other side over here, if you have any worries at all, just making sure that there's an efficient transfer of wealth to your loved ones. That's what we want our clients to be.
So that's a great segue into our next subject on estate planning and how you can efficiently transfer your wealth onto your loved ones. So I think most people are under the impression that if they have a will in place, then they have an estate plan taken care of, but it's not a very efficient estate plan.
Right.
Because a will does not avoid probate court at all. A will is simply a letter to the probate court explaining where you want your assets to go. So probate is costly. It can cost between, on an average, the AARP says probate costs between 5 and 8% of an estate. It can cost up to 11% is another number that I've seen at the very top. And it also takes a lot of time. It can take months and even years to settle an estate, depending on how complicated the estate is, if it has to go through probate court. So the only way to avoid that is to establish a living trust. And a living trust avoids probate completely if it's properly funded. So that means that all the assets that you own are placed in the name of the trust, entitled in the name of the trust. And if you could elaborate a little bit on how exactly that works.
Let's talk about how probate kind of works. The probate occurs when somebody dies and their name is on the title of an asset. So if I have a house, let's forget about that I'm married or whatever. Let's say your mom passed away before me and I have this house, our home, titled in the name of Bob Benny, and I die. That asset is owned by a dead person now. It has to go through the probate process and the court process in order for the probate court, the state of Nebraska or the county of Lancaster County in Nebraska, to decide who gets the house. Well, if I have a will, it's basically just a letter to the probate court telling them what I want to do, but it still ends up causing, having a significant attorney's fees and court costs and time to get it through that process. And like Jesse said, could be, in the range of 5 to 8% or more. Well, conversely, we have a trust. It's the Benny Family Trust. Angela, my wife, and I are the trustees of it. If one of us dies, the other one's still the trust. The second one dies. Now we have a house, an asset titled in the name of the Benny Family Trust. In the trust, it says who the successor trustee is. The successor trustee's job is to manage and distribute the assets owned by the trust according to the wishes of the trust. And so basically we die and the house titled in the name of the trust that I was using as an example, my successor trustee can go to a real estate company and say, hey, this trust owned, or this house owned by the Benny Family Trust, I want to sell it. Here's the trust. Here's my parents' death certificates. The trust says that when they're dead, I'm the successor trustee. So the real estate company can sell the house. Person that buys the house makes the check out to the Benny Family Trust, which is just fine with the successor trustee because he or she goes to the bank with the check made out to the Benny Family Trust, and he's already gone to the bank and taken control of the Benny Family Trust checking account, and by showing them the trust and the death certificates, and that's how things flow into the trust checking account that he or she has control over and then distributes it. That's kind of in a nutshell how a trust works to avoid probate. If assets go through probate, you're inadvertently making a law firm and the court system a beneficiary of your estate. And so that's what we want to avoid.
All right, so other things living trust does, like we talked about, it speeds up the estate settlement because it's not caught up in the court system.
Right.
It also keeps matters private. Anything that goes through probate is public information.
Right.
So anybody can access any information about probate and where you decided to leave your assets. It also preserves both federal exemptions, which doesn't really apply right now, but could apply in the future.
Could apply in the future. Right now, you're okay. A married couple's okay with leaving over $22 million to their beneficiaries without any estate taxes.
So the essential parts of an estate plan are, first and foremost, the revocable living trust that we just talked about, a power of attorney for finances, advanced healthcare directive or power of attorney for healthcare, proper titling of assets and beneficiary designations. So we talked about that a little bit as far as titling your assets in the name of your trust. There's some assets that cannot be titled in the name of your trust that you need to make sure that you have proper beneficiary designations on. So those are in particular retirement accounts. So your 401k, IRA, or Roth IRA need to have a specific beneficiary designation on them. So it's important to make sure that those are updated with the people that you want those assets to go to. And then lastly is a pour over will. And a pour over will is basically kind of a catch-all document where if you forget to put something or title something in the name of your trust and it accidentally goes to probate, the pour over will is a letter to the court saying, I meant for this to go in my trust. And it's just meant to speed up the process of probate if that happens, kind of as a last resort,
like a safety
emergency.
net. It's like a safety net if something inadvertently, accidentally got left outside of the trust, right?
Right.
So we help our clients with estate plans. I have helped the clients with estate plans and helping them develop revocable living trusts and all these ancillary documents that Jesse just talked about. We've been doing that for over 20 years. And we use a company called LegalZoom that you may have heard advertised. LegalZoom is an internet-based company that helps you produce your own legal documents like the revocable living trust and the other powers of attorney and et cetera that we talked about. And you can do this yourself, but we help people because we know how to do it. We've gone through their software. And so I help people all the time do this. Clients and non-clients help set up revocable living trusts and estate plans using LegalZoom. LegalZoom's they're very inexpensive. They're charged for a whole complete, all the documents you need will range in between $400 and $450. That's all in. That takes care of the legal documents for everything. We don't charge anything or make anything out of that. We do ask that in lieu of paying me anything for doing it, that you make a voluntary contribution to my favorite charity, which is Royal Family Kids Camp. It's a charity I've been involved in for over 10 years, and I can tell you about that if you're interested and if you want to come in. We don't require people to make this donation or ask how much they make it for. They make it for whatever they want. But anyway, we'd love to help you with any of these things that we've talked about, whether it's retirement income planning or investments or inflation strategies or estate planning or any of that. And so go ahead and
let's check and see. We're going to give you guys just a minute or two to type in any questions that you might have if you haven't typed them in already. And we'll check and see if there is a question up here. It looks like there is one. Can you address
question
that?
about taxes? Questions on my views on the IRS bill where any expenditure over $600 have to be reported to the IRS. I'm not exactly sure what he's talking about. However, the deductibility of if you pay a vendor or a person, what I think he's talking about is if you pay somebody over $600 for something, you have to report it to the IRS and they get a 1099 on it. You have to send them a 1099. And so they have to be taxed on the income of the $600. That's if you're deducting the $600. That doesn't mean that if I give you $1,000, Jesse, and I'm not deducting the $1,000 as a business expense, I can give you the $600 or the $1,000 and I don't have to report it to the IRS. I can give you a lot more than that and I don't have to report it to the IRS. Do we have another one on there yet or not? We're about out of time anyway. So if you have further questions, because I don't want to take too much of people's time. We've been doing this about 45 minutes so far. You can give us a call. The office number is 402-421-2626. Or you can email us at bob@bobbenny.com or at jesse@bobbenny.com, and we'd be happy to help you. and we can help you talk about ways to save money on taxes. Somebody asked a question up here, ways to avoid taxes and insurance, and that's certainly something that we'd be glad to answer those kind of questions for people, but it's kind of too deep of a question to give a quick answer on saving money on taxes. It's right now at this point, but
if you want to email us that, we can go into a little bit
sure,
more detail.
get a little bit more specific.
So we just want to, a little extra that we want to give you guys for as a thank you for attending our webinar is we have a little ebook that's 46 frequently asked questions about retirement that we're going to email to everybody that was on this webinar today that hopefully you find helpful.
Yeah. So thank you very much for attending, and we appreciate you, and God bless.